Welcome to the Asset Revolution podcast, where each week your hosts from Arbor Digital provide educational opportunities for financial advisors and individual investors to gain knowledge in this emerging powerhouse that is digital asset investing. The Asset Revolution podcast is your connection to the future of digital assets and an opportunity for anyone to get off zero. Let's dive in. Alrighty, everybody, welcome back to the latest edition of the Asset Revolution. This is part 2 of a series we are conducting with Keith Black. So if you haven't yet, be sure to go listen to part 1, which is all about valuation analysis and modeling. And today on part 2, we are going to dive into risks, all about crypto, digital asset investment, and I guess some other types of risks that you may not recognize, but that are inherent to this new ecosystem. And so before we go into part 2, just in case you are coming into us for the first time and have not listened to episode 1, Keith, welcome back to the show and introduce everyone.
Thanks, Mark, and it's great to be back with you. So I've been in crypto since 2018 and in financial markets since the 1990s. So I've got experience trading commodity derivatives and equity derivatives. And I was also a consultant for pensions and endowments, helping them with their hedge fund allocations. For the last 12 years, I was with CAIA Association, and I was helping write their textbooks and exams on alternative investments. And now I'm working more in the crypto space.
And wonderful. And for those of you who don't know, the CAIA is one of the global standards when it comes to alternative assets. So very, very prestigious organization. So really great. And we are so lucky to have someone like yourself, Keith, to have us go through this 2-part episode series. So you are no stranger to analyzing, measuring, reflecting, and just overall thinking about risk when it comes to assets, investing. So I'm really excited to dive into that with this new ecosystem of digital assets today. So what I figure we do is let's kind of just level set first for the audience. Let's kind of go through some of those risks and just define them, because I know you've done some work on it. So where would you start? What are the main risks that you think people should be thinking about today when it comes to digital assets?
So I think you want to start with the traditional markets, the stock and bond market. And the main risk there is simply volatility risk and then inflation risk. So what we know is that stocks can be volatile. They might go up 30% one year, down 20% the next year, and so that volatility risk is real. And ideally, our bond portfolio would be less volatile than that. So volatility risk is the major risk in the traditional stock and bond markets. And then obviously this year, we're very concerned with inflation risk. And as a general rule, when inflation rises, prices are rising, and we see interest rates rising as well. And the faster interest rates rise, the more challenging it is for stocks and bonds to end up with positive returns. So those are the main risks we're looking at in the traditional markets. Then we can move into the alternative markets, and we could look at hedge funds, private equity and venture capital, and then real assets like real estate and infrastructure. And one of the reasons I got interested in crypto was my job at CAIA was to find the new thing in alternative investments and make sure that I was educated on it before people started asking questions. And we added digital assets into both the CAIA and the financial data professional curriculum. So once you move away from the liquid stock and bond markets, now you've got all kinds of other risks that come into play, because typically you don't talk about liquidity risk in the public markets. You typically don't talk about leverage risk in the public markets, and certainly you don't worry about custody in the stock and bond markets. But as you move into alternatives and crypto, now you have to deal with leverage risk, liquidity risk, and custody as well.
I think that gets lost a lot on, especially as new investors. Again, I think we mentioned this on the last episode, how, especially with digital assets, it's very much driven, retail driven. The initial manifestation of the markets, very retail driven, which is very different than the traditional space or even other traditional alternatives. And I don't know if I could say that traditional alternatives. I think that's also coming in. So it's really important to highlight those risks, because you may not have thought about them because you're so used to these other worlds. So I'd like to kind of move then in. And we've seen some of those risks play out in real time over the last couple of months, given what we've seen with Three Arrows Capital. And these are nothing new. And we touched upon this in the last episode. So now take us into, how do you think about these risks now, when you think about digital assets specifically?
It's interesting because some of the people in digital assets come from a tech background without a lot of training in finance. And then you've got these people from centralized finance or Wall Street or CFI coming into the space as well. And the people who are crypto native or digital native might not have that market history under their belt. And so we're actually recreating a lot of the crises that we've had in the past. And so if you look at Celsius and Voyager and BlockFi and Three Arrows Capital, people are comparing those to long-term capital or Lehman Brothers, right? And so one of the things we saw was a liquidity mismatch. And so one of the key things, and you learn about this in hedge funds, is you don't want to offer greater liquidity to your investors than you have in your asset pool. And so part of this issue was that we're waiting for the merge on Ethereum. And a lot of people had their assets locked up in staked Ethereum, which is locked in and not able to withdraw until that merge happens. And hopefully it's happening in September, but it could be delayed for years, because we've been talking about the merge since 2018. And so one of the key issues in crypto recently was this liquidity mismatch. And people were worried about the Terra Luna, the stable coins. And what we had was people who had the ability to withdraw their assets, but the assets of the platform weren't necessarily liquid. So if everyone on your platform decides to withdraw their assets, and half your assets are in staked ETH, right? Now you've got a little bit of an issue in that you can't cash out everyone at the same time. Also, we worry about concentrated lending, right? We saw that
concentrated risk is yeah.
Yeah, I mean, some of these lending platforms that failed, had a third or 2/3 of their assets lent to just one or two counterparties, right? And if that counterparty goes under, then there's a lot of risk there. And then we could look back at the global financial crisis, and we had issues with mortgages and subprime and all these credits. And then there's these structured products. So some hedge funds might have been in convertible bond arbitrage or mortgage-backed arbitrage, and they were running, maybe 5 times leverage, maybe 15 times leverage, right? And they ended up, posting, between 30 and 100% losses during the GFC, and that's just at 5 to 15 times leverage, right? And so one of the risks that there's all these YOLO traders in crypto, right? And they want to trade crypto at 10 times leverage or 100 times leverage, but Bitcoin and Ether have 5 times the volatility of a stock market index, right? And in the US, you're allowed to trade stocks at 2 times margin, right? And if you trade Bitcoin futures at Chicago Merc, it's maybe 4 times margin, right? And so and when you buy a house, right, 10 to 20% down, right, that's 5 to 10 times leverage. And so there's not really easy ways to get more than 10 times leverage in the US financial system, right? Even though houses and bonds and stocks, right, have less than a quarter of the volatility of crypto, right? And so what some people are doing in this leverage space, they're trading crypto at 10 to 100 times leverage. It's hard to trade that in the US, but overseas there are people who trade this. And we see that, Ether is up 50% in 3 weeks, right? Because we're hearing that the merger is going to happen. And so if you're trading at 100 times leverage, right? You have to be glued to your screen when that's happening, because
Mm-hmm.
a 1% move is either going to double your money or wipe you out,
Wipe you out. Yep.
right? And we have 1% moves, every day or even every hour in crypto, right?
Mm-hmm.
And so the leverage risk and the volatility risk is extreme in crypto. And I think that there's not this native risk management or respect for risk in the crypto spaces there is in the traditional markets. And volatility risk works both ways, right? And so if Ether can move up, 50% in 3 weeks, well, guess what? It can move down, 50% in 3 weeks, or down
Mm-hmm.
20% in a day, right?
Mm-hmm.
And so for a lot of the last couple of years, there's a lot of new people coming into the crypto space, and they're saying, wow, look at what this coin did. This coin did 2x or 5x or 20x, right? And it's going to go to the moon, and this is going to continue. But what we know from the CeFi world is, something that does 2x or 20x, it's volatile,
Mm-hmm.
right? And even though it's been going mostly higher, right, that's still volatility, and that's still risk. And clearly there could be moves to the downside as well.
Absolutely. And that's why we wanted to start off with kind of level setting, understanding the risks first before we start talking about possibly how you can manage those risks. And especially having a history, having that wisdom, and that's where you have this new ecosystem where you have two, it seems like it's really centralized in two different worlds. Like you have the tech workers that are making the leap, and then you have your financial professionals that are making a leap from TradFi to DeFi. And I think for anybody who has not made that leap, or maybe even still at the beginning stages of that, they actually put CeFi, centralized finance players like a Three Arrows Capital, BlockFi, Voyager, any of the names that you listed, and then they think of decentralized finance names. You were thinking like Sushi Swap, Uniswap, Aave, Compound, and they actually, and again, I'm talking about the people who haven't made the leap and haven't educated themselves, and to those who are maybe at the beginning of those journeys, they actually lump those two together. So it's important to also state and level set from a risk standpoint that the same risks aren't inherent actually to DeFi like they are with CeFi. So now that we've gone through some of those CeFi risks that we just kind of went through, can you talk a little bit now, risks maybe specific to the crypto native side and decentralized finance?
And I think there's two key risks here: custody risk and smart contract risk. And
what does that mean, Keith? I hear those words thrown around so much. Please just tell us, what does that mean?
I got you, Mark.
Okay, good.
and I think that institutional investors, the pensions and the sovereign wealth funds, they're not largely invested directly in the coins yet. Maybe they're into hedge funds or venture capital that are in the space, but they're not really investing in the coins yet. And I think that the two main hurdles for institutional investors are the valuation properties that we talked about last time, and then custody.
Mm-hmm.
And so there's basically two ways to have custody of your crypto, and most people will do their first trades on a centralized exchange, right? They'll buy their crypto on Coinbase,
like
on
Coinbase,
Binance,
Gemini,
on Gemini,
okay. Mm-hmm.
on Kraken. Most of the people will do their first trades there, because that's where you go from fiat to crypto. That's where you trade your dollars for Bitcoin or Ether,
mm-hmm.
or stable coin. And then once you have those assets, now you can go into the DeFi world, right? DeFi doesn't take US dollars. DeFi doesn't take euros, right? Mm-hmm. They take digital versions of these. Yep. And so some people are comfortable keeping their coins on exchange. Mm-hmm. And it feels like a brokerage account. You log in, and you could have a password reset. You could have beneficiaries, and there's bids and offers, and you could look at your balances. It's a very familiar to people who've done online stocks or options trading. But the problem is on a centralized exchange is that you don't control the access to that crypto, right? Not your keys, not your crypto, mm-hmm. right? And the keys are your password, right? And nobody could take the crypto out of your account, Nobody can move it to another address without having access to those keys. But whenever you're storing your crypto on that exchange, it's the exchange who has access to your keys. Now, another twist to this is that in some of these liquidations we're seeing is that the coins that were controlled by the exchange or the lending platform or the crypto counterparty, where people were holding their crypto assets for yield, those crypto assets are counted as assets of that platform and not necessarily as the assets of the individual
Of the client.
Investors, right? Because there's no FDIC insurance, right? There's no SIPC insurance, right? So this isn't a bank and this isn't a brokerage firm. And so now we're seeing that that client balances are getting commingled with platform assets, and that's kind of a mess as well. So previously we were worried about cybersecurity, right? Previously we were worried that somebody could hack into an exchange, steal the private keys, and then transfer all the crypto out. And so a lot of people had kind of focused on that cybersecurity risk, but now we're seeing this risk of commingling assets, which again is exactly the same as what happened with Lehman Brothers in 2008. And there were some clients who had custody in the wrong part of Lehman Brothers, and their assets weren't segregated for the clients. They actually went in to that Lehman bankruptcy and had to try to get assets that way. Now a quick aside about Lehman is that this Terra Luna $40 billion stablecoin loss is bigger than Lehman Brothers, right? And in a positive nod to DeFi, right? There's very little contagion outside of crypto from this loss in Terra Luna. Now remember when Lehman Brothers blew up, the global housing market declined by 20%, right? And now we've got losses in this Terra Luna stablecoin system that are bigger than the losses at Lehman, and it's all been relatively contained.
And this is highlighting again some of the benefits and again, as much as we like to sometimes make people aware of the shortcomings of our traditional systems, there are a lot of benefits as we talk to security. It's much easier to hand off managing the cybersecurity risks and all that to a centralized partner, and there are some benefits there. But now we're starting to highlight, okay, this is where DeFi is different, and this is where DeFi, I mean decentralized finance, and where there are some improvements that could be made through DeFi, as one you just highlighted there. And actually, from what we've seen over the last few months is the use case for DeFi and why it can be so important to a well-functioning and healthy monetary system, especially one that's all transparent. And so one of the risks I think that, especially within CeFi, that I think gets misrepresented within DeFi is that counterparty risk. So can you maybe talk a little bit about counterparty risks in DeFi? How does it differ from in CeFi or even TradFi?
There's a couple of key differences, right? And what we see in crypto is that there's a tremendous amount of transparency, right? And whether you're writing information to the Bitcoin blockchain, the Ethereum blockchain, the Solana blockchain, and so on, that information is available. And so there's some benefits to having that degree of transparency. And the first thing is you can't rehypothecate your assets to multiple counterparties, right? So there's been people in the past who've taken whether it's silver or houses or stocks, and they've borrowed against them in 5 different places and exceeded the risk limit that any of those counterparties would have given them.
And then those other parties who are giving that to the investor, whoever's taking out this, they actually can't go verify that this collateral isn't being used. But in DeFi, you can.
That's right.
Okay.
Right, because in a well-functioning DeFi platform, once you've collateralized or we call it total value locked, once you've put that collateral into a specific DeFi system, it can't be used again in another DeFi system, right? And so if you're going into, say, make or DAI, right, and you want to mint some DAI stable coins, you're going to have to put up, Ethereum or Bitcoin or some other asset. And that might require 170% collateralization. And so if you put up $17,000 worth of Ether, you could take out $10,000 in stable coins. And now you can't use that Ether anyplace else because it's locked into that DAI trade, but you can use that $10,000 in stable coins for other purposes, right? But that original stake in ETH, or that original position in ETH, because stake is something special, is locked into that specific counterparty. So you can't go and pledge that same collateral at 4 different places and get to a higher level of leverage than you're supposed to have.
But Keith, can I just then go to Aave CEO or investment group who I have a friendship with from college and just say, hey, can I just do a deal with you on the back end? Just trust me on this. I can't go do that in DeFi.
Well, that's what smart contracts are about.
Okay,
right?
Tell us about that.
And so smart contracts are computer programs that are run by a group of blockchain miners or validators. And so you've got this idea of an Ethereum virtual machine, right? Or you could run smart contracts on Cardano or Solana or Avalanche and some of these other proof of stake networks. And so what happens is not only do you have the transparency in crypto, you also have those rules that are encoded, right? You don't have this ability to have special treatment, right? And so if you want to go out to Aave and borrow or lend, you have to follow the same rules as everyone else that's coded by the smart contract, right? And if the smart contract says you have to have 170% collateralization in order to do this specific investment or trade or borrowing, if you put up 169%, the computer is going to say, well, no deal, right? You got to follow the rules. And so some people really like this, and it democratizes things, right? And so they don't know if you're 12 years old, they don't know your race or your religion or your gender or your location in the world. All they know is, you have $17,000 worth of Ether and you want, $10,000 worth of DAI. And if you follow the rules and the smart contract, then you get the deal.
Yeah, and I think that's a reason why philosophically a lot of people who may have been treated unfairly or have been part of groups that have experienced injustice in their history when it comes to financial inclusion. This is why this is so transformative and revolutionary, is this idea of fairness through smart contracts. And this idea of programmable money, I think, is a term that gets thrown around. What you just described is essentially the how behind what it means when somebody says programmable money. So if you're going to take anything away from this episode, Keith just gave that and dropped that in about 10 seconds, and I hope you can walk away with that. So we talked about custody risk, and we've just started talking about now the ideas of smart contracts and programmable money. Let's go into the risks of those. So what are the risks of smart contracts? Because you said that term, smart contract risk. Let's now level set there.
Well, let's take a couple of steps back, right? So
okay,
on that underrepresented space, right? We see that 7 of the top 10 countries whose citizens are participating in crypto have some kind of issue with their banking system, their government, their freedoms, and their currencies, right? And so some of the countries that are most involved in crypto are Ukraine and Nigeria and used to be China, and we can't verify that now, and then Venezuela, right? And so 7 of the top 10 countries that are involved in crypto are involved because there's some degree of financial repression, right? That the government isn't honest, the government's over controlling, the government has increased the volatility of the fiat currency or decrease the value of the fiat currency. And obviously in the case of Ukraine, we don't necessarily know how well their banking system is working at the moment. And so those people have used crypto and they could invest in stable coins. They don't have to get into the volatility of Bitcoin or Ether. And so any stable coin is going to preserve value much better than their own fiat currency. And then then back to the custody side, we talked about the custody on exchange, right? And it's super convenient, it's super easy. It's called a hot wallet, right? You can move your funds on a moment notice, but you have the cybersecurity risk that somebody will steal your coins from the exchange. But now we see some platforms have restricted withdrawals, right? And so if you're concerned about the financial condition of your centralized exchange or your lending platform, you might not want to keep your coins in that platform, because whenever they're on that exchange, whenever they're in that lending platform, who's ever running that program has the ability to restrict withdrawals. Now, you could take your crypto off exchange, right? And so you could put your crypto in a hardware wallet or a soft wallet or a cold wallet, and you're taking your financial life into your own hands, right? So a hardware wallet might look like a USB drive, right? And so you take the crypto off the exchange, you load it into the USB drive, and then what do you do with the USB drive? You take it out of your computer, right?
Exactly. Don't leave it in.
Right. And so when your hardware wallet is loaded up on something that looks like a USB drive, you could put that in your desk, you could put that in your safe deposit box, and now you have the fiscal custody. Nobody can steal your coins if they're on your hardware wallet, and your hardware wallet is physically secure, right? But there's risk of the hardware wallet as well, right? And so, a USB stick is really easy to lose, right? So if you can't find it in your house, if there's a fire, if there's a flood, if it gets stolen, or more likely, you and I might know a lot about crypto. We might have a hardware wallet, but have you told your wife or your kids or your financial advisor or your business partner, where the hardware wallet is, and the keys and the access codes to get at it, right? Because if it's lost in a fire, if it's lost in a flood, if you die and you don't give your family or your business the keys, right, that crypto is gone forever, right? And so there's risk to taking custody on an exchange or a lending platform, but there's also risk in taking custody into your own hands as well.
Yeah, and you're affirming. We did an episode with an estate planner, Matthew McClintock, who runs a business, and he narrowed in on this niche market of helping developers, tech entrepreneurs, and other very wealthy families or individuals who are very engaged with the investing in this space, both via centralized exchange and via self-custody. And he talks about all of those things you just mentioned about those risks. And that's a way you can help manage those risks, is by working with someone like that, or, like us at Arbor Digital, who are financial advisors in this space, to where we can help guide you through that as well. So that's a way that definitely you can help manage those risks. So yeah, Keith, very well said. So is there anything else on the custody side you then mentioned before we go into smart contract risk?
I think custody is one of the most important things, right?
Yeah, it's the reason why it's number one, right?
If you get the custody wrong, right, nothing else matters.
Yep.
Right. Valuation doesn't matter. Due diligence doesn't matter. Right. Yep. If you don't know the right way to custody this, then your whole investment is at risk.
Absolutely. It's why it's at the top of the stack, 100%.
So now on to smart contract risk, I think was your next question.
Yes. Again, let's do it, because I think a lot of people listening to this probably have heard 7 different definitions, 7 different ways explained to them, and they still don't understand it. So hopefully, Keith, you are the magic person to help us really understand what smart contract risk is.
Right. So
no pressure.
No pressure. So smart contracts, again, are simply computer programs that run these crypto protocols, right? And
Keith, if I could jump in there too, what that even really means, would you even say it's as simple as an if-then statement when you're writing code? Is that fair?
If-then statements are a key part of smart contract risk, right? So let's write a couple of smart contracts right here. Right?
Okay, let's do it. I'm ready.
Okay. So if you contribute Ether to make or die, right, you can withdraw 1 divided by 1.7 of your Ether balance in DAI, right? That's the first thing, right? If you contribute it, you can withdraw some portion, right?
Yes.
Based on that collateralization ratio, right? Now, just like a futures exchange, you have to maintain that collateralization, right? So now there's another thing, right? if the value of your collateral falls below the required level, right, you have to put more money in, right? You have to put more of your original ether into the protocol, or you have to pay back part of that loan in DAI, right? And so those are the two main statements in DeFi, right? But you could build any kind of business based on a smart contract, right? And so there's insurance companies that are living in the smart contract space, right? And so flight insurance might be a hot topic right now, given the way that the airlines are melting down, right?
Yeah.
And so you could interact with a smart contract, and you send them some crypto, and you say, here's my payment for insurance, right? And my payment for insurance is whatever, $29, right? And so if someone sends us $29 and their flight information, more than 48 hours before the flight, right? Then if that flight is canceled or delayed by more than some amount of time, the smart contract is automatically going to pay you, right? So imagine being at the airport, right? You look up and you see your flight canceled, and 6 minutes later, you have money in your crypto wallet, right? From this payoff of the insurance, right? Because the flight insurance system is tied into all of the flight scheduling apps, right? And they can see that your flight was delayed or rescheduled or canceled, and they'll automatically pay you out right there. So imagine before you even leave the airport, you have that payout from your flight insurance, and you might use that to buy another flight on another airline.
So Keith, I think a lot of people listening, and where we've talked about this and we've heard it ourselves, is, and I'll put this question to you so that way they can hear your answer, is how come we can't do this now? What stops us?
I think people still have a hesitancy to interact with crypto, and maybe custody is the biggest part of that hesitancy. But I think that blockchain, not necessarily crypto, is going to become more and more ubiquitous, and the killer app is using crypto when people don't know they're using crypto or blockchain.
Well said.
Right? And so if you can buy your plane tickets, if you can buy your sporting tickets, your concert tickets on just some app called tickets whatever, right? It could be totally run on the blockchain, right? But it just looks like a regular app to you, right? And so if you put all of the techno words aside, some people love it, some people hate it, right? You put all the custody risk aside, it's like all in this app, right? People trust an app on their Android or their Apple phone, and your tickets or your insurance just show up there. If you don't know it's using crypto, if you've got a super easy user experience, then that's going to be the way that crypto works, because there's a lot of complexity in the way crypto works right now. And even guys like us who are determined and want to get it done, sometimes we sit around struggling trying to make something work in the crypto space.
Yes, the struggle is very real. No, I appreciate you going into that, because I think it helps also give context to, now we've talked about smart contracts, what they do, how they operate a little bit, but now let's get into the risks. So all this good stuff, if this is all happening, so what are my risks in a smart contract?
So no computer program is perfect, right? And the computer program does whatever the computer program is told to do, right? And what's super unique about crypto is a lot of this is open source, right? So before you ask people to trust like $10 billion to your platform, right? Maybe you'll actually publish the code, right? And there's people out there who will actually audit the code, right? There's 47 things that could go wrong with the computer program, and they know how to run the code, they know how to read the code, and they're going to go through a checklist, just like you're hiring a hedge fund and you go through that due diligence checklist. You might do the same thing with a smart contract. Right? How do you get money in? How do you take money out? How much can you lever? How fast can you do this? How slow can you do that? Right? And so you go through this checklist. And some people say the code is the law, right? And so you have to really trust your development team here, right? Because we're putting our assets are, billions of dollars. I think there's $700 billion locked in, or $70 billion locked in
70,
DeFi.
yeah.
$70 billion locked in DeFi now that's trusting all of this computer code, right? Now, a lot of that code has been published, a lot of that code has been inspected, but some people say the code is the law, right? So, Mark, if someone steals $10 million, right? Are
Okay.
they a criminal or are they brilliant, right? Because
Not mutually exclusive. They're probably both.
not mutually exclusive, right? But could you take $10 million from a crypto platform and have it not be a crime? Could you, if you're smart enough to understand this code, and if you're smart enough to understand a very specific vulnerability in the code, you can go out, you can steal $10 million from some DeFi platform.
Mm-hmm.
And sometimes the people who built the platform will say, thank you.
Mm-hmm.
Right? Or, if you give, half of it back, so I could help my investors. If you give half of it back, you could keep the other half, because what you've done is you've shown me a vulnerability in my program. Right. And
So is that the risk to smart contracts, is vulnerability in the code?
Right. Because, there's a lot of smart people here and there's a lot of money here. There's $70 billion up for grabs. And, people can sit there and read the code and beat on the code and, try all these kind of strange combinations. And, sometimes they'll figure out a way to, we call it a smart contract exploit.
Mm-hmm.
Right? You're not necessarily like hacking in and taking somebody's password and stealing money. You're actually using the smart, you're actually executing the computer program the way that computer program was written, right? But not necessarily the way the computer program was intended to be written.
Mm-hmm.
Right? And so you are, technically within the law by executing against that computer program the way that it's written.
So if I'm hearing you correctly, and to walk away, for everyone listening to walk away with, it sounds like, so the risk to smart contracts or bugs in the code, maybe another thing that you've heard, is the idea that this code that is open source, again, open source is great, but one of the things is when you're open source, you open yourself up to everybody. Anybody can go in and try to do this, right? It's a little different. So if we had to list that risk, it's more just exploitation risk or vulnerability or code vulnerability risk, is kind of how you, I guess, say that.
That's right.
Wonderful.
And you know what my favorite risk is, Mark?
A favorite risk. I can't wait to hear this.
Vampire risk.
Okay. Well, so we're getting down to the kind of, I think a lot of people talk about technology risk, another term that gets thrown around in this space a lot. So I think, does that fall under that risk, or is that still smart contract risk?
It's kind of both, right?
Okay.
So, and it goes back to this open source, right? Because if you're in public equity, or if you're a venture capitalist, one of the things you'll look at is that companies' barriers to entry, right?
Mm-hmm.
Do they have huge economies of scale where it takes a lot of money to recreate what they have? Do they have patents and secrets, and do they have special people or special techniques? And in public equity or in private equity, you have the ability to protect a lot of your intellectual capital. Mm-hmm. You have the ability to have patents, and you have the ability to have secrets. And if you're able to build a better mousetrap, the law actually prohibits other people from copying your mousetrap, right? But in that open source is kind of a two-edged sword, right? Because open source gives people the confidence that the smart contract is going to run correctly, that it's okay to put billions of dollars on this platform, because honestly, people probably wouldn't put billions of dollars into these platforms if they didn't see the code, right? Mm-hmm. Because you have to have that trust that there's no obvious vulnerabilities there. So the upside to open source is that you could audit the code and you could see how safe it is, how efficient it is, and exactly how something works. And you could have the safety or the confidence that your funds are going to be safe. So that's the upside of the open source. Now, the downside of the open source is illustrated by Uniswap and SushiSwap, right? And so Uniswap and SushiSwap are decentralized exchanges, right? And so in the decentralized exchange, you say, okay,
Can you give an analogy of what that maybe would look like in the traditional world? What's a counter?
I don't know if
term?
there is a decentralized exchange in the traditional world, right?
Well, there isn't a decentralized one, but when you think of what Uniswap or SushiSwap does, help people connect. What can they what's that analogous to in the real world?
I mean, it's just a stock exchange or a futures exchange, right?
Perfect. Thank you.
We're simply taking one asset and exchanging it for another.
Perfect.
Right. And so you could sell a stock, right? So you say, I'm going to give you, 100 shares of Amazon, and you give me, X dollars in cash, right? And you execute that on the NASDAQ stock market, right? And so in the centralized exchanges, there's only 100 coins or 200 coins that Americans have access to. And so if you look at your Binance, your Kraken, your Coinbase, your Gemini in the US, you have maybe 50 or 100 or 200 choices, even though there's 20,000 cryptocurrencies, right? And so the centralized exchanges say, we've done our due diligence, we pick these coins, and these are the ones that we're going to allow you to trade. But if you go out to Pancake Swap on Binance or Uniswap on Ethereum, they say you could trade 600 coins or 3,000 coins, right? And so if you want to own some of these smaller cap cryptos, there's not a way to do that on a centralized exchange, at least in the US, right? So now, a simple thing in Uniswap is I'm going to send 0.1 Ether to Uniswap, and I'm going to give it an instruction to send me back, X number of a token that I can't buy on a centralized exchange, right? So you send your Ether and some instructions to Uniswap, and then it sends you back the number of tokens you requested in that other crypto asset. Now, the Uniswap was one of the first and the most successful decentralized exchanges, and their code was open source. And they got to a pretty significant valuation. They're trading a lot of volume. There's a lot of people who are contributing assets as liquidity providers who are in that ecosystem to facilitate those trades, kind of like floor brokers on the stock exchange or the options exchange. And I sold you 200 at a quarter, right? So Uniswap was one of the first and largest decentralized exchanges, and when they were growing, they had a lot of users, right? So people were interacting with them as traders. I'm sending you some ETH, and I want this other token back. And then other people were saying, I'm going to put a bunch of my crypto assets into Uniswap, and I'm going to facilitate trades for other people, and I'm going to get paid as a liquidity provider, kind of like a local on the stock exchange or the futures exchange. So one of those traders said, yeah, Uniswap's kind of neat, but if I was running Uniswap, I'd do it a different way, right? And so along comes SushiSwap, and what SushiSwap did was they copied the entire Uniswap source code, right?
So just right-click copy.
Right-click copy. Right.
Yep.
I mean, you can't do that for, IBM or JP Morgan or Amazon, right?
I can't go into Google, take the code that they've written for some of their algorithms, right click copy, and then take it and go build my own. Engine. Exactly.
Right. and so they republished it as SushiSwap with maybe 70 or 80% of the source code of Uniswap intact, right? So they started off with the entire source code of Uniswap. They said, I'm going to do this different. I'm going to enhance this. I'm going to change this. But 70%, 80% of the code was the code from Uniswap. And within a matter of weeks, Mark, SushiSwap had 1/3 of the trading volume of Uniswap and $1 billion valuation.
And right? That's what a vampire attack is?
That's what a vampire attack is, right? And this is probably the scariest thing for me in crypto long term. Right? Is there is no barriers to entry, right? Anybody can create a new coin. Anybody can copy a protocol and come up with their own. And so this is great for consumers, right? That the innovation is running at 1,000,000 miles an hour, and and it's really easy to build incrementally on top of what's already there. But if you really like Uniswap and you say they've got a great market share, this is going to be a great investment, and I want to hold this coin for the long term because I want to participate in that ecosystem, and I think it's a strong product. The ability of someone to simply literally copy your business model in a few months, that could be the scariest part of crypto, is that there's no barriers to entry and it's difficult to protect your IP.
And I think this actually gets lost for the people that are more crypto native, everyone. And I think this is one of the things that we see a lot is, where you fall on the spectrum, either you're all the way in or you're on this other side of the spectrum. And when you're all the way in, it's when people come to you, and this is where it's important, when we see, how the groups that help govern all of these protocols, how do they react when other people come and make up these points, right? So someone goes to the Uniswap group and says, this can be done. Are you guys scared of this at all? And then if you see everyone just completely dismiss it, that's a red flag. And so that's very relevant, though, from what you're saying. It's a risk, especially for the long-term viability of the entire ecosystem. Really, what does it mean to invest in a coin or a project or a network? And I think that's where, network effects come into play. Just because you can copy it doesn't mean, there's a lot of different examples now showcasing themselves. Bitcoin and Bitcoin Cash is another example, right? That you could say it's probably not the same thing, but that's more of that was a fork of Bitcoin Cash was. And, everyone said this is the death of Bitcoin, but then it's still here. So there's these other things you have to play into, but you just don't know.
That's right. And, in the private equity world, the public equity world, you could count on that intellectual property protection, right? You could have patents, or you could just not tell everybody what you're doing. You've got your, Colonel Sanders' secret recipe that's never disclosed, right? And if nobody could figure it out, right, then you've got a good business that you could replicate for a long time going forward, right? But in this world of open source, it's a lot harder to protect the work that you put into that platform.
Yeah, that's an interesting thought exercise. Would KFC be as successful as it was if Colonel Sanders made his recipe open sourced? Who knows what we would have?
Who knows?
Well, Keith, we've gone over a lot of the risks. We've gone over some traditional ones. We've gone over some centralized finance risks, and we've definitely dove into some of the decentralized finance risk inherent to digital assets and the crypto markets. So I'm hoping that everyone enjoyed this episode and took away a lot more learnings from disciplined, level set perspectives from you, Keith. And I really appreciate you coming on and sharing all of this knowledge. This is something we are passionate about at Arbor, and just sharing it and making our own knowledge open source. So it means a lot that you come on the podcast to share this with everyone in our audience.
Thanks, Mark. And if I could leave one last lesson, right?
Absolutely.
There's a lot of risk in crypto, and crypto is volatile, right? Don't put all your money in crypto, right? And when you look at financial advisors, people who are working with people, if you're not in the space full time, if you really don't know what you're doing, you want to mix this in with your cash, with your stock, with your bonds, with your other alternatives, with your house, and all of that. And a lot of people recommend positions. I don't know what size you guys talk about, Mark, but in the 1 to 5% of your assets range is kind of a reasonable place to start in crypto, because there are a lot of risks, and there's certainly a lot of upside. You can make a lot of money in crypto, right? But you don't want to be that person on Twitter that says, I lost $3 million on Terra Luna, and now I don't know how to make my house payment, right? And so there are a lot of risks here, and so if when you're going to start trading, you start trading small.
Very well said, Keith. And yeah, and I promise, audience, I did not ask Keith to tee us up so well with that, but yeah, absolutely, that's one of the value adds of advice, whether it's in traditional markets, crypto markets, any markets. You have to manage your risks. So you just highlighted a few ways, and the way we help investors manage their investment risk when it comes to digital assets is, yeah, we recommend a 1 to 5%, and that's based off of data and Monte Carlo simulations, given some, very volatile inputs, such as, volatility metrics that we know and love in traditional markets that we've learned to use. We can apply those same things that we've learned and built in the traditional world to help us manage investment risk in these assets. So we help people do that. Absolutely. So we are right in that 1 to 5% range that you mentioned, Keith. And that's just based off the data. That's a comfortable range, and not too far out. And then when you go internally for that and managing, we determine buy zones for our cash. And we have a high risk zone, an intermediate risk zone. We have a low risk zone for any time someone wants to put cash in the markets. We say, here are our 3 different zones based off all of this data that now we have transparency into, both on chain and then using some of what we already know off chain in traditional ways. So that's a little bit how we do it. And you're absolutely spot on. That's the value that we can bring. But sorry, this isn't about us. This isn't about Arbor. This is about you, Keith, and bringing us aware of all of these risks. And what I really appreciate, and I hope you walk away from, is I hope now we've listed out some of the risks to think about, but also level set on some of those definitions, because I think that's one of the struggles we have in this industry right now, is that there's so many different definitions. Everyone has different language that they use to define these terms. So I hope we've given and I know you've given that to the audience today on the episode. So what I'd like to end off with, Keith, we did a couple quick fire questions on our last one. I have a couple more if you're willing to go through another round.
All right.
Okay. So the first question that I didn't get to ask before was around, what is a learning from your parents that you take with you today?
Saving money and investing, right? My father was a pretty frugal person, and on a school teacher's salary, he was able to reach some pretty significant investment levels, and it's just that discipline of saving on a regular basis, kind of max out your 401k kind of thing, and you don't necessarily miss that 10% in your paycheck. Especially because it's pre-tax, and then 30 years later, you're like, oh wow, this actually works.
And very important, savings and investing, not just savings. Well said. Okay. Second question: what is something that detractors of crypto get right?
In the last episode, we talked a lot about Web 2 versus Web 3. Right. And the lessons of Web 2 is that besides maybe travel and music, right, the entire e-commerce space still only has like a 20% market share of retail sales, right? And so the people who are the crypto natives really into things, we're going to shut down the entire banking system within 5 years. Right. And so we have to kind of temper these expectations and say that DeFi might be an exciting thing, and it might take some market share, but it's probably going to take a lot longer than we thought. And again, in the previous episode, we talked a lot about valuation and due diligence. Right. The detractors from crypto say all of this is worthless. Right. I agree. Right, that over 80% of today's cryptos are worthless in the long run, right? Which is why you have to have that discipline, that due diligence, and that valuation. And so there are a lot of scams. There's a lot of zero value projects, and so you want to look at what's the project, what's the team, and what's the network, right? So if there's not a business plan, if there's not a code, if there's not a protocol, if there's not followers, if there's not users, it's not going to have significant value in the long run. So the detractors say all of crypto is worth zero, right? And by the number of coins, right, 80+% are worth zero, right? And so they do get that right. We're not going to be 100% DeFi in the world within 5 years, right? They probably get that right. But on the upside, there are, I don't know, 3 or 13 or 30 cryptos, right? Or digital projects that could have a substantial value and change the way we do things in the long run, right? So think of what Amazon and Priceline did as survivors from Web 2, and how those have completely transformed our lives and transformed industries. There's probably a handful of cryptos out there today that could have that same transformative impact, and not necessarily just in finance over the next 5 to 20 years.
Well said. I think that's a great spot to end off our two-part series. Now, just because we did a two-part series does not mean we are not going to bring Keith back on. Keith, I'm excited for a lot of things we have in the pipeline to partner together aside from just this podcast. So everybody listening, there's your little teaser. Keith has so much more to also share with the world that he is working on with people outside of Arbor and others as well. And I know me, Keith, and our team here at Arbor are very excited, very happy to see that there are individuals like yourself who are putting the work in a disciplined and thoughtful way to help push this industry forward. So from us, a big thank you.
Thanks, Mark.
All right. Well, thank you everyone for joining us for this two-part series for the Asset Revolution podcast. Have a great weekend. Be sure to tell somebody today that you care about them, and we will see you on the next edition. Bye.
Bye.
We appreciate you listening to this edition of the Asset Revolution podcast. I'm your host, Marc Nichols. Please don't forget to let us know how you like the show by rating and reviewing us on Apple Podcasts or wherever you like to listen. For more downloadable digital asset resources and educational opportunities, please visit us at arbordigital.io. We are here to help you get off zero safely and securely. Thanks again for tuning in, and be sure to tell someone you care about them. Cheers.
We are financial advisors. However, we are not your financial advisor. Unless you're under contract with or actively speaking with Arbor Capital Management or Arbor Digital, a division of Arbor Capital Management. This podcast is just that, a podcast. It is not financial, legal, or tax advice. If you have individual questions, please reach out.